A retired couple in California had $120,000 a year in retirement income, pension, IRA withdrawals, carefully saved over 35 years. Their neighbors in Wyoming had the exact same income, same pension amount, same IRA withdrawals, same savings. At the end of the year, the California couple wrote a check to the state for $7,080. The Wyoming couple wrote nothing, zero, not because they were smarter, not because they had a better accountant, because they lived in a different state. Over 25 years of retirement, that $7,000 difference becomes $175,000. $175,000 gone. Not to the federal government, not to the IRS, to the state they chose to retire in. And most Americans over 60 make this decision every single year without ever running these numbers. Today, I'm going to show you exactly which states are taking the most from your retirement, and the ones that protect almost every dollar you saved. I am Kevin. The state you retire in is one of the most consequential financial decisions you will ever make. And almost nobody talks about the actual numbers. Let me show you exactly what those numbers look like. Let me start with the good news. 9 states in America charge 0 state income tax, 0 on your Social Security, 0 on your pension, 0 on your IRA or 401k withdrawals. Those 9 states are Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, Wyoming. If you retire in any of these states, the state takes nothing from your retirement income. But here is what most people do not know. 0 income tax does not mean 0 total cost. And some of these states have hidden expenses that can erase every dollar you saved on taxes. In Florida, the most popular retirement state in America, the average homeowner's insurance premium is now as high as $15,000 a year in some areas, the highest in the nation. Driven entirely by hurricane risk, in Texas, there is no income tax, but effective property tax rates in major cities are among the highest in the country. Austin, 218%, Dallas, 222%, Houston, 231%. On a $400,000 home, that is $9,240 a year in property taxes in Houston. In Nevada, there is no income tax, but Nevada ranks 48th in the nation for primary care physicians per capita. The state faces healthcare shortages in every county. In Tennessee, there is no income tax. But Tennessee has one of the highest combined sales tax rates in the entire country. And unlike most states, groceries are taxed, up to 6.75% with local taxes included. On a fixed income, the grocery tax adds up every single week. The no income tax states are real. The benefits are real. But the full picture always includes more than one line. Stay with me, because the next section is where most Americans get hurt. And it starts with a state that surprises everyone. Let me walk you through the 3 worst states for retirement taxes. And I am going to show you the exact math, not estimates, real numbers, verified calculations. Worst state number 1, California. California has the highest top state income tax rate in the entire country, 13.3%. Social Security is exempt in California. That is the one piece of good news. But your pension, taxed. Your 401k withdrawals, taxed. Your IRA distributions, taxed. All of it. At California's progressive rates. Here is the exact calculation for a retiree with $120,000 in retirement income from pension and IRA withdrawals. After California's standard deduction, the tax comes to approximately $7,083 per year. Every year, not once. Every single year you live in California. Over 25 years of retirement, that is $177,000 to the state of California. On money you already worked for. On money you already paid federal taxes on. And California's cost of living sits approximately 38% above the national average. So the tax hits harder because every dollar buys you less. Worst state number 2, Minnesota. Minnesota taxes private pensions, 401k withdrawals, and IRA distributions as ordinary income at rates ranging from 5.35 to 9.85%. And Social Security is taxable for single filers earning above $84,490. The state offers subtractions, but the income tests are extremely strict. The age 65 subtraction requires a single filer to have an AGI below $33,700 to qualify. Most retirees with pension income do not qualify. A retiree with $65,000 pension and $25,000 Social Security in Minnesota is paying approximately $4,500 per year in state income tax every year. Worst state number 3, Vermont. Vermont has the lowest threshold for taxing Social Security of any state in the country. For 2025, Social Security becomes taxable for single filers with an AGI above just $55,000. Above $65,000 for single filers, there's no exemption at all. Vermont's income tax rates go up to 8.75%, and Vermont has an estate tax with a steep rate on top of that. The state's total tax burden is estimated at 11.1% of personal income, one of the highest in the nation. These three states, California, Minnesota, Vermont, represent the highest combined retirement tax burden in the country, but they are not the only ones. Connecticut taxes Social Security for higher earners and has some of the highest property taxes in the nation. Montana continues to tax Social Security despite a 2025 bill to repeal it failing. Rhode Island taxes Social Security for single filers earning above $107,000. Utah taxes Social Security through a credit system that phases out completely above income thresholds. Colorado taxes Social Security for filers under age 65 who earn above $75,000 single or $95,000 joint. The pattern is the same in all of these states. The money you saved in a tax-deferred account becomes fully taxable income the moment you start withdrawing it, and the state takes its cut before you ever see a single dollar. Now let me show you something that surprises most people. The best kept secret in retirement tax planning is a state with an income tax, Pennsylvania. Pennsylvania has a flat income tax rate of 3.07%. Most people see that number and stop reading. Here's what they miss. Pennsylvania exempts 100% of Social Security from state tax. Pennsylvania exempts 100% of pension income from state tax. Pennsylvania exempts 100% of 401k and IRA withdrawals from state tax. The 3.07% rate only applies to earned income, wages, investment income, capital gains. If you are retired and living entirely on Social Security, a pension, and retirement account withdrawals, your Pennsylvania state income tax bill is zero, functionally identical to living in Florida, but with world-class hospitals within driving distance and homeowners insurance, a fraction of what Florida charges. That same retiree paying $7,083 in California pays zero in Pennsylvania on the same income, $7,083 every year. Stays in their pocket, not the state's. 4 other states offer similar or equally strong protection. Iowa, as of 2023, all retirement income is fully exempt for residents aged 55 and older. Mississippi, all qualified retirement income is exempt from state tax. Illinois, all qualified retirement income is exempt from its 4.95% flat income tax. Georgia offers a retirement income exclusion of up to $65,000 per person for those aged 65 and older. A married couple in Georgia can exclude up to $130,000 of retirement income. These states have income taxes on paper, but for retirees, they function almost identically to no income tax states. That is the part nobody's article tells you. Stay with me, because the next section covers something that just changed in 2025 and 2026, and it directly affects which states are now better or worse than they were last year. 3 major states just became significantly more retirement friendly, and if you have been avoiding them, those numbers have changed. First, Kansas. Kansas has fully eliminated state income tax on Social Security benefits, completely gone. Second, Missouri. Missouri has fully eliminated state income tax on Social Security benefits. Third, Nebraska. Nebraska has also fully eliminated state income tax on Social Security benefits. These 3 states removed a significant tax burden that previously affected every retiree receiving benefits. 2 more states are becoming more favorable in 2026. Connecticut. For retirees meeting AGI thresholds, IRA distributions will be 100% deductible starting in 2026, previously only 75%. Colorado. Starting in 2026, income caps on Colorado's pension and annuity deduction will be removed entirely. Michigan will complete its phase out of retirement income taxes by the 2026 tax year. Most retirement and pension benefits will be fully exempt. And one state just added a major property tax benefit that makes it look completely different than its reputation. New Jersey, famous for the highest property taxes in the country. Starting in 2026, the Stay NJ program provides a credit for 50% of a senior's property tax bill, up to $6,500 annually. For seniors 65 and older with income of $500,000 or less, a state that everyone lists as expensive, just handed eligible retirees up to $6,500 back every single year. The landscape changes. And the states you wrote off 5 years ago may no longer deserve to be on that list. Before I give you the action checklist, I want to cover something that costs retirees thousands of dollars every year, not because the programs do not exist, because nobody told them to apply. Texas seniors over 65 receive a mandatory $100,000 exemption on school district property taxes, plus a freeze on the amount of school taxes paid, meaning they can never increase above the year you turned 65. Never. New York's Enhanced STAR program provides school tax relief for seniors 65 and older with income of $110,150 or less. The application deadline is generally March 1st. Pennsylvania's property tax and rent rebate program provides up to $1,000 back for homeowners and renters age 65 and older. The 2025 rebate deadline is June 30th, 2026. Illinois freezes the assessed value of your home through the Senior Citizens Assessment Freeze program, protecting you from property tax increases as your home value rises. Income limit, $75,000. Georgia seniors age 62 and older can receive a complete exemption from all school district property taxes, often the largest portion of the entire property tax bill. These programs are real. They are funded. They are waiting for your application. And most eligible seniors never apply because nobody told them they existed. Here's what to do with everything I just showed you. 1. If you live in California, Minnesota, or Vermont, run the exact calculation on what your state takes from your retirement income annually. Multiply that number by 25. That is the total retirement cost of your state choice. 2. If you're planning where to retire, do not stop at income tax rates. Add property taxes. Add insurance costs. Add healthcare access. Add sales tax. The full number tells you whether the move actually saves money. 3. If you live in Kansas, Missouri, or Nebraska, your Social Security is now fully exempt from state tax. If your preparer is still withholding state tax on Social Security income, correct that immediately. 4. If you're a senior homeowner, go to your county assessor's website this week, search for senior homestead exemption, search for property tax freeze, search for property tax rebate program. Every state has something. Most seniors never apply. 5. If you are considering leaving a high tax state, Pennsylvania, Iowa, Mississippi, Illinois, and Georgia all have income taxes on paper, and zero effective tax on most retirement income. Compare those states to Florida and Texas on total cost, not just the income tax headline. The median income for U.S. households age 65 and over is approximately $56,180 a year. That is the national median. And the total tax burden on that income can range from 5% in the most protective states to over 12% in the most expensive. On 56 that difference is over $3,900 every single year. For a retiree on a fixed income, $3,900 is groceries for 6 months. It is a heating bill for a year. It is prescription costs for an entire quarter. The state you live in determines which version of retirement you get, not your portfolio, not your Social Security check. The zip code on your tax return. That is what this channel exists to show you. This video is for educational and informational purposes only. Nothing here constitutes tax, legal, or financial advice. State tax laws change annually. Always consult a qualified licensed tax professional before making any relocation or financial decisions. Sources include verified data from Empower, Kiplinger, Tax Foundation, California FTB, Minnesota Revenue, AARP, and individual state tax department publications. If this video helped you see the full picture, subscribe now and turn on the bell. Next week, I'm covering the Social Security decision most Americans make at 62 and why it costs the average person $180,000 over their lifetime. I do not want you to miss it. If you know someone planning where to retire, send them this video today. The $175,000 difference starts with this information. Drop a comment below. Which state are you retired in or planning to retire in? Tell me what you're paying. I read every single one. And the most common situations become the next video. I will see you in the next one.